The most expensive admission fee you'll ever pay is the cost of belonging. Most people never realize they're paying it because conformity feels like safety, acceptance, and intelligence. It's only later, when the bill comes due, that you understand how much it actually costs to think like everyone else. The Westfield Investment Club met every first Thursday of the month in the back room of Morrison's Steakhouse. 12 successful professionals, doctors, lawyers, executives, entrepreneurs, gathering to share investment ideas and pool their collective wisdom. They called themselves sophisticated investors, and by most measures, they were average net worth over $2 million, graduate degrees, decades of market experience. Robert Chen had been invited to join after selling his engineering consulting firm. The club's reputation for generating superior returns through collaborative research had attracted him, along with the intellectual stimulation of debating investment strategies with other accomplished individuals. For the first year, he felt grateful to be included in such an exclusive group. Margaret Willis was the unofficial leader, a hedge fund manager whose confident presentations dominated the monthly meetings. She had an MBA from Wharton and a track record of identifying growth trends before they became obvious to the broader market. When Margaret recommended a stock, the group listened. When she explained why certain investments were outdated or risky, members typically adjusted their portfolios accordingly. The group dynamics were subtle but powerful. Members who suggested popular, trendy investments received enthusiastic support and detailed follow-up questions. Those who proposed unfashionable ideas faced polite but pointed skepticism. Nobody wanted to appear out of touch or behind the curve. The social pressure to suggest intelligent-sounding investments gradually shaped everyone's thinking toward consensus. In 2019, the club was unanimously bullish on technology growth stocks. Margaret had given a compelling presentation about the digital transformation megatrend that would reshape every industry over the next decade. The group allocated heavily to cloud computing companies, electric vehicle manufacturers, and software-as-a-service businesses. The valuation seemed high, but everyone agreed that traditional metrics didn't apply to revolutionary growth companies. Robert felt increasingly uncomfortable with the group's concentrated exposure to expensive growth stocks, but he kept his concerns to himself. When he suggested adding some boring utility companies or consumer staples to provide defensive ballast, Margaret politely explained why those legacy sectors were poor investments in a digital economy. The rest of the group nodded in agreement. Nobody wanted to appear old-fashioned. The social validation was intoxicating. When the growth stocks soared in 2020, the group felt vindicated and brilliant. Their monthly meetings became celebrations of their collective wisdom and superior insight. They had identified the future before the market fully understood it. Members bragged about their returns to friends and colleagues, cementing their reputations as sophisticated investors. Robert participated in these celebrations while quietly building a very different portfolio. Outside the club meetings, he was buying companies that the group considered obsolete. Procter & Gamble, Coca-Cola, Johnson & Johnson, Walmart, Berkshire Hathaway. These businesses generated steady cash flows, paid reliable dividends, and traded at reasonable valuations. They weren't exciting, but they were profitable and predictable. He never mentioned these purchases to the club. When asked about his portfolio allocation, he discussed his growth stock holdings, which comprised about 30% of his investments, and let the group assume that's where most of his money was invested. It wasn't deception exactly, but it wasn't full disclosure either. The social cost of appearing unsophisticated seemed too high. The turning point came gradually, then suddenly. Interest rates began rising in 2021, making expensive growth stocks less attractive relative to bonds and value stocks. The companies that had been priced for perfection began missing earnings estimates or providing disappointing guidance. Valuations that had seemed reasonable when money was free started looking absurd when investors could earn real returns from safer alternatives. Margaret assured the group that this was temporary volatility, a healthy correction in an otherwise sound secular growth trend. She recommended using the weakness as an opportunity to add to their best ideas at lower prices. The group followed her advice, viewing the decline as validation of their contrarian courage rather than a warning about their fundamental assumptions. Robert watched the club's favorite stocks fall 20, 30, 40%, while his boring value holdings either held steady or declined modestly. Procter & Gamble actually rose as investors sought refuge in companies with predictable earnings and strong balance sheets. Coca-Cola's dividend provided a real return when growth stocks offered only promises of future profits. Walmart thrived as consumers became more price conscious. The monthly meetings grew tense as losses mounted. Members who had felt brilliant 18 months earlier now questioned their judgment and Margaret's recommendations. Some blamed external factors, Fed policy, inflation fears, geopolitical uncertainty for their poor performance. Others wondered whether they should cut their losses and move to more defensive investments. Margaret maintained her conviction, arguing that short-term market sentiment was irrelevant for long-term investors. She cited historical examples of innovative companies that had faced temporary setbacks before generating enormous returns for patient shareholders. The group wanted to believe her partly because the alternative meant acknowledging they had made fundamental errors in judgment. Robert found himself in an impossible position. His contrarian portfolio was significantly outperforming the club consensus, but he couldn't reveal this without appearing to have deceived his fellow members. Worse, admitting his success would require explaining why he had rejected the group's collective wisdom in favor of his individual judgment. That felt like a betrayal of the collaborative spirit that had attracted him to the club initially. The psychological dynamics became increasingly uncomfortable. Members who had bonded over their shared confidence in growth investing now faced the prospect that their judgment had been clouded by groupthink rather than enlightened by collaboration. The social cohesion that had made the club enjoyable was built on a foundation of mutual validation that was crumbling along with their portfolios. By early 2022, the group's performance had become undeniably poor. The technology stocks that had been bid up to absurd valuations were now trading below their pre-pandemic levels. Electric vehicle companies that had been valued like established automakers despite producing no profits were losing 90% of their market value. Software companies trading at 30 times revenue were being repriced at more reasonable multiples. The club's average portfolio was down 40% from its peak, while the broader market had declined only 15%. The sophisticated investors who had felt superior to index fund investors were now underperforming by massive margins. The cost of their collaborative approach was becoming impossible to ignore. Robert finally revealed his true portfolio allocation during a particularly difficult meeting in March 2022. When Margaret suggested that the group might consider reducing their growth stock exposure, he quietly mentioned that he had been mostly invested in value stocks for the past 2 years. The room fell silent as members processed this information. The questions came quickly and defensively. Why hadn't he shared this insight earlier? Why had he let them believe he was following the same strategy? Did he think he was smarter than the rest of the group? Robert tried to explain his reasoning that he had felt pressure to conform, that he valued the group's friendship more than investment disagreements, that he hadn't been confident enough in his approach to advocate for it publicly. Margaret was particularly offended. She interpreted Robert's independent approach as a lack of respect for the group's collective intelligence. If he had insights that contradicted her recommendations, she argued, he had an obligation to share them with other members. His silence had been selfish and undermined the collaborative process that made the club valuable. The irony was perfect and painful. Robert had been punished for conforming by keeping his contrarian views private, and now he was being punished for not conforming by revealing them. The group that had claimed to value diverse perspectives had actually created an environment where dissent felt impossible and independence seemed disloyal. The club disbanded within 6 months. Members who had enjoyed each other's company for years found it difficult to maintain relationships after their investment approach had failed so dramatically. The social bonds that had been strengthened by shared success were weakened by shared failure. Nobody wanted to be reminded of their collective misjudgment. Robert's portfolio, meanwhile, had outperformed the S&P 500 by significant margins during a period when most sophisticated investors had underperformed dramatically. His boring value stocks had provided exactly the defensive characteristics he had expected, protecting capital during market turbulence while generating steady income through dividends. The most valuable lesson wasn't about investment strategy, it was about the hidden costs of social conformity. The Westfield Investment Club had attracted intelligent, successful individuals who had achieved remarkable things in their professional lives. But when they came together as a group, their individual judgment was gradually subordinated to collective consensus. This wasn't a conscious decision. Nobody explicitly agreed to suppress dissenting opinions or punish contrarian thinking. The pressure to conform emerged naturally from the social dynamics of wanting to belong, to appear sophisticated, to maintain harmonious relationships with respected peers. The club's collaborative approach gradually became an echo chamber where popular ideas were reinforced and unpopular ideas were discouraged. Social proof is one of the most powerful forces in human psychology. We look to others to determine what's normal, acceptable, and intelligent. In most areas of life, this tendency serves us well. But in investing, social proof becomes a liability because markets reward contrarian thinking and punish consensus approaches. When everyone agrees that certain investments are attractive, prices rise to reflect this consensus. By the time sophisticated investors reach agreement about an opportunity, it's usually too late to generate superior returns. The most profitable investments are often the ones that feel uncomfortable, unpopular, or boring to the majority of market participants. The Westfield Investment Club fell into the classic trap of mistaking correlation for causation. Because successful people had gathered together and reached consensus, they assumed their conclusions must be correct. They confused social validation with analytical rigor, group intelligence with individual wisdom. The fact that everyone agreed became evidence that they were right rather than a warning that they might be wrong. Professional investors face similar pressures amplified by career risk. Fund managers who underperform while following conventional strategies are more likely to keep their jobs than those who underperform while pursuing contrarian approaches. The penalty for being wrong along with everyone else is much smaller than the penalty for being wrong alone. This creates systematic bias toward popular, defensible investment strategies rather than profitable ones. Warren Buffett has written extensively about the professional investor's dilemma. Most managers have very little incentive to make the intelligent, but with some chance of looking like an idiot decision. Their personal gain-loss ratio is all wrong. If an unconventional decision works out well, they get a pat on the back, and if it works out poorly, they get a pink slip. Individual investors should have more freedom to think independently, but they often surrender this advantage by seeking validation from others. Investment clubs, online forums, financial media, and social networks all provide opportunities to compare ideas and seek confirmation. The comfort of agreement comes at the cost of contrarian insight. The most successful investors in history have been notably independent thinkers. Benjamin Graham developed value investing principles that were initially ridiculed by efficient market theorists. John Templeton built fortunes by buying when others were selling and investing in countries that other investors avoided. Peter Lynch achieved legendary returns by trusting his own research over Wall Street consensus. These investors didn't succeed because they were smarter than their peers. They succeeded because they were more comfortable being isolated from their peers. They could tolerate the social discomfort of disagreeing with respected authorities and sophisticated institutions. They valued being right more than being accepted. The challenge for individual investors is developing this independence while maintaining enough humility to recognize when they're actually wrong rather than just unpopular. Contrarian thinking can become a trap if it leads to automatic rejection of consensus views, regardless of their merit. The goal isn't to always disagree with the crowd, it's to think independently about each situation and accept whatever conclusion the evidence supports. Robert's success didn't come from superior analytical skills or better information. His advantage was psychological. He could tolerate owning boring stocks that made other people uncomfortable. He could endure the social pressure of appearing unsophisticated while his peers pursued exciting but expensive investments. He valued the approval of market results more than the approval of market participants. The cost of conformity isn't always immediate or obvious. During bull markets, following the crowd often produces satisfactory results. The penalty comes when market conditions change and popular strategies that worked in one environment fail catastrophically in another. By then, the social bonds that encourage conformity make it psychologically difficult to change course. Investment clubs, in particular, create powerful incentives for groupthink. Members want to maintain relationships, avoid conflict, and contribute to group harmony. Disagreeing with popular ideas feels antisocial even when it's analytically sound. The collaborative process that's supposed to improve decision-making often leads to compromise solutions that satisfy everyone but optimize for nothing. The solution isn't to avoid all social interaction around investing, it's to structure those interactions in ways that encourage independent thinking rather than consensus building. The most valuable investment discussions focus on challenging assumptions, identifying risks, and exploring alternative perspectives rather than reaching agreement about what to buy or sell. Individual accountability is crucial. When investment decisions are made collectively, no single person bears full responsibility for the outcomes. This diffusion of accountability reduces the psychological pressure to think carefully about each decision. Members can blame poor results on group dynamics, incomplete information, or changing make conditions rather than their own judgment errors. The Westfield Investment Club's failure wasn't unique or unusual. Similar patterns play out constantly in investment committees, pension funds, and financial advisory groups. Intelligent, well-intentioned people gather together and gradually surrender their individual judgment to collective consensus. The social benefits of belonging come at the expense of analytical rigor and contrarian insight. Professional money management companies understand these dynamics and often structure their processes to encourage independent thinking. Some firms require analysts to submit recommendations without discussing them with colleagues first. Others assign devil's advocate roles to force consideration of alternative viewpoints. The most sophisticated organizations recognize that their greatest enemy isn't market volatility, it's their own tendency toward groupthink. Individual investors rarely implement such formal processes, but they can apply similar principles. Before discussing investment ideas with others, write down your reasoning and conviction level. Seek out contrary opinions rather than confirming evidence. Be especially skeptical of investments that seem obvious or generate unanimous enthusiasm among your peers. The psychological appeal of conformity will never disappear because humans are social animals who crave acceptance and validation. But understanding the costs of this conformity can help investors structure their decision-making processes to minimize its influence. The goal isn't to become a hermit, it's to maintain intellectual independence while benefiting from social interaction. Robert eventually started his own investment approach based on the lessons he learned from the club experience. He continued meeting with other investors, but he changed how he participated in those conversations. Instead of seeking validation for his ideas, he used the discussions to stress test his assumptions and identify potential weaknesses in his reasoning. His new approach was fundamentally solitary. He made investment decisions alone, without seeking consensus or approval from others. He valued contrarian perspectives, not because they were contrarian, but because they forced him to examine his own biases and blind spots. He measured success by portfolio performance rather than social acceptance. The results spoke for themselves. Over the next 5 years, His independent approach continued generating superior returns while maintaining lower volatility than the broad market. The boring stocks he had been embarrassed to own became the foundation of sustainable wealth creation. His willingness to appear unsophisticated had made him genuinely sophisticated. The conformity cost is one of the hidden fees that most investors never see on their statements. It doesn't show up as an expense ratio or transaction cost. It appears as opportunity cost, the difference between what you earned by following the crowd and what you could have earned by thinking independently. For most investors, this is the largest fee they pay. The cruel paradox is that the people most likely to pay this fee are often the most successful in other areas of their lives. High achievers are accustomed to being rewarded for intelligence, hard work, and social skills. They expect these traits to generate similar success in investing, but markets operate differently than most other competitive environments. In business law, medicine, and academia, collaboration and consensus building are generally valuable skills. Successful professionals learn to work well with others, to build coalitions, and to communicate ideas persuasively. These same skills become liabilities in investing, where independent judgment and contrarian insight generate superior returns. The most expensive lesson that intelligent people learn about investing is that intelligence alone isn't enough. Social intelligence, which serves them well in other contexts, often works against them in markets. The need to appear knowledgeable, sophisticated, and current can override the more important need to be right. This is why some of the most successful investors had been notably antisocial or eccentric. They weren't burdened by the need to fit in or seek approval from their peers. They could pursue strategies that seemed boring, obvious, or outdated because they valued results more than reputation. Their social awkwardness became a competitive advantage in an environment that punished social conformity. The investment industry thrives on this dynamic, selling products and services that make investors feel sophisticated and informed rather than actually improving their results. Complex strategies, exclusive opportunities, and insider insights all appeal to the psychological need to feel special and smart. The simplest, most effective approaches, buying index funds and holding them forever, don't satisfy these emotional needs. Robert's story illustrates a broader truth about success in investing in life. The crowd is usually wrong when it matters most. During periods of calm and prosperity, following conventional wisdom produces acceptable results. But during times of crisis and opportunity, conventional wisdom leads to conventional disasters. The individuals who prosper during these periods are those who can think independently when independence is most difficult and most valuable. The conformity cost isn't just financial, it's psychological and intellectual. People who surrender their individual judgment to group consensus gradually lose confidence in their ability to think for themselves. They become dependent on others for validation and direction. This dependency makes them vulnerable to manipulation and leads to poor decisions across all areas of their lives. Breaking free from conformity requires courage, humility, and a fundamental shift in how you measure success. Instead of seeking approval from others, you must learn to trust your own analysis and judgment. Instead of trying to appear sophisticated, you must be willing to look boring or unsophisticated when that's what the evidence supports. Instead of following the crowd toward exciting opportunities, you must have the discipline to pursue boring investments that compound wealth over time. The reward for paying this psychological cost is not just financial, it's the freedom to think for yourself in a world that's constantly trying to think for you. That freedom, once acquired, becomes the foundation for all other forms of success. And in investing, where independent thinking generates superior returns, that freedom quite literally pays for itself many times over. The Westfield Investment Club's failure was inevitable because its structure encouraged the wrong behaviors. The members' desire to belong, to appear intelligent, and to maintain social harmony gradually overwhelmed their individual judgment and analytical capabilities. They paid the conformity cost without realizing it until the bill arrived in the form of devastating portfolio losses. Robert succeeded not because he was smarter or more knowledgeable than his peers, but because he was willing to think and act independently when independence felt uncomfortable and risky. He chose the discomfort of social isolation over the comfort of intellectual conformity. That choice, repeated over many years, generated wealth that no amount of social validation could match.